Statement of cash flows. We know that accrual basis accounting provides useful information about the economic endeavors of an organization. It captures revenues when earned and expenses when incurred. It follows the activity, not the cash. But ultimately, cash is king. The statement of cash flows helps financial statement users assess quality of earnings and the future cash flows that an investor could expect. It allows us to understand how cash is being invested in the business, the acquisition or sale of property, plant, and equipment, and also how cash is being used to finance the business, whether using stock or loans, such as bonds. To help financial statement users with these assessments, the statement of cash flows provides three classifications: operating, investing, and financing. The statement of cash flows does them in this order, from top to bottom. I think it's easier to understand them, however, if we work from the bottom up and think about the life cycle of a company. In order to begin a business, we first have to finance it. We need to raise capital in order to start the business. Cash inflows and outflows related to financing the business are summarized in this category. A company could choose to issue stock or issue bonds or other forms of loans in order to finance its activities. As the company begins operations, it eventually will repay the loans, may repurchase some stock, or pay dividends back to equity investors. All of these activities are summarized in the financing category. Notice, however, that the payment of interest does not go in this category. Payment of interest is an operating activity. It's the cost of the day-to-day use of someone else's money. Investing activities, those transactions involving the purchase and or sale of long-term assets, land, building, machinery, the property, plant, and equipment that we will use in our business. All purchase or sales of these items are summarized as investing activities. So we first finance our business, we raise some money, we use it then to acquire PP&E. Now we're ready to begin business. When we begin our day-to-day operations, we will summarize those items as operating activities. This is the normal receipt, revenues, and the payment of expenses in the ordinary course of business. These expenses would include interest. There are two different methods under which the statement of cash flows can be prepared: the direct and indirect. The direct method ignores net income and simply summarizes cash inflows and outflows. The indirect method begins with a net income and reconciles accrual basis accounting to the change in cash. This is the method that businesses use, and this will be the one that we focus on. Because we begin with net income under the indirect method, we must adjust for non-cash effects of accrual basis accounting. Things like revenues earned on account or expenses incurred on account, depreciation, and other non-cash effects. Let's consider depreciation as our first non-cash example. Recall the journal entry when we record depreciation expense. We debit depreciation expense, credit accumulated depreciation. Notice, does this journal entry decrease net income? Yes, clearly it does. We're recording an expense. However, does it decrease cash? Cash is not involved in this entry. We have an expense and we have a contra asset account. No change in cash. So if we're using the indirect method, we're going to begin with net income. Our starting point include this expense of 10. There is no change in cash. We will see that in order to reconcile, we're going to have to add back the depreciation expense in order to explain the change in cash. Let's examine an example. Let's assume that to begin business operations, Max borrows $600 from the bank. He then uses the $600 to buy a lawnmower. And then in the third month, March, Max begins his mowing operation. Max expects the lawnmower to last for 60 months, so in March he begins depreciating the lawnmower at a rate of $10 per month. In January, Max only obtains a loan. He has no revenues and expenses, and therefore no profit or loss for the period. He obtains $600 cash and has a liability. The statement of cash flows under the indirect method would begin with net income, 0. We would explain in the financing section we obtained a $600 loan. Our net change in cash for the period was $600. We began with nothing and ended $600. In the second month of operations, Max used the $600 to buy a lawnmower. No revenue or expenses, and 0 net income for the period. Max's cash balance falls from $600 down to 0, but he's acquired a lawnmower. February's statement of cash flows would begin with net income, 0. We would explain that we purchased equipment. This is a cash outflow, $600. This change in cash explains how we went from a beginning balance of 600 to an ending balance of 0. In March, when we begin operating activity, Max receives $200 from customers, pays $30 for gasoline and other expenses. Max's revenues of $200 minus his operating expenses of $30, and the depreciation that we must record of $10 leaves net income of $160. Notice that cash resources for Max, however, go up by $170, which is the $200 of revenues minus the $30 operating expenses. Recall that the depreciation is a non-cash expense. On the statement of cash flows, we begin with the $160 of net income, but we will add back the $10 depreciation expense, which is a non-cash expense. We would report $170 as our cash flow from operating activities, and this will explain our change in cash for the period. $170 began with 0, and we end with $170 in our cash balance. Other non-cash items of revenue and expense that we need to adjust for include changes in current assets, such as accounts receivable, and change in current liabilities, such as unearned revenue or wages payable. For changes in current assets, our rules will be to subtract increases in current assets and add decreases in current assets. Notice that it's an opposite relationship here. For an increase, we're going to record a subtraction. For a decrease, we're going to record an addition on the statement of cash flows. This is the adjustment we make on the statement of cash flows. To illustrate, we will use what's called T-account analysis. For a simple example, assume that the beginning balance in accounts receivable is $50. Current year activity is as follows: $100 in credit sales, debit account receivable, credit sales revenue, and then $80 of cash collections, debit cash, credit accounts receivable for $80. Our ending balance in the account receivable would be $70. We have an increase in this current asset of $20. The rule of thumb that we just discussed was, for an increase in the current asset account, we must record a reduction on the statement of cash flows. We would begin with net income, which in this simple example would be only our revenue of $100. We have no expenses. We would make an adjustment for this increase, so we would say less the change in our account receivable. We would subtract out the 20, and that will reconcile and explain that our change in cash was only 80. Notice why this adjustment makes sense. Regardless what the amounts are, debits to the account receivable account will be made for credit sales. Credits to the account receivable amount will be made for cash collections. So what we are adjusting for really is the difference between these two. If credit sales exceed cash collections, we're going to have an increase in the account, as we did in this example. And thus, we need to subtract that increase out with the reduction that we made here. Let's do that illustration again, assuming we have an increase in the account receivable. Again with 50, we have our credit sales of 100, and instead let's assume that we have 140 in cash collections. So cash, debit 140, credit account receivable for 140. In this case, our account receivable balance would end at 10. We would have a reduction of 40, and on the statement of cash flows, this reduction we would need to add. We would again begin with net income, which is still in this simple example only our 100 of sales revenue. We would add a change in account receivable, because in this case it was a reduction. We will add that, and this would explain that our change in cash was 140. Again, what we're adjusting for is the relationship between our credit sales and our cash collections. On the liability side of the balance sheet, we will make adjustments as well. For increases in current liabilities, we will make an addition on the statement of cash flows. For decreases in current liabilities, we will make a subtraction adjustment on the statement of cash flows. Notice that on the liabilities side, the adjustment is the same. If the liabilities are increasing, our adjustment on the statement of cash flows will be an addition. If current liabilities decreased, then our adjustment on the statement of cash flows likewise will be a decrease. We will examine this more in class.